anniversary of a birthday. I'm celebrating the anniversary of my 39th birthday. Welcome back, American Dreamer. You're listening to Michigan Real Talk. We're talking real estate, business, and finance every Sunday noon here on 92.7 FM, AM 1400, The Patriot. And we're talking about your American dream and what it takes to get there.
Yes.
That's why you want to work with some of Michigan's finest professionals like Tim Pascarella of Team Pascarella, powered by Ross Mortgage in studio again. Welcome back, Tim.
Hi, everyone. How's you doing? Happy birthday.
Thank you very much. Happy anniversary of our 39th birthday.
Yes.
But listen, you told me something about LPMI. And in the real estate business, there's always these abbreviations. Now we're talking about
Lender-paid mortgage insurance.
Lender-paid mortgage insurance. Now, mortgage insurance in general, we know what the basic concept here is. The lender is lending you lots and lots of money to buy. They got a lot of money out the door.
Yes.
So you can be in a great home. If something went wrong with that loan, God forbid, some reason you couldn't repay it, they have insurance to cover themselves,
Yes,
right?
Absolutely. Yeah. If you put less than 20% down on a conventional home right now, you're going to have to pay mortgage insurance, which is a monthly payment towards your mortgage.
Because if you have better than 80%, if you have equity in that home, and God forbid you couldn't make the payment, the mortgage people will be all right because they'll be able to sell it back, get their money.
Exactly.
But if you don't have much equity in that home, they're covering their potential loss. So mortgage insurance is required for How many people you think are in mortgage insurance in your personal practice? Most people are in mortgage insurance situations, or
I would say out of every 10 deals we do, probably 7.
Yes.
At least 7 or 8.
More than it used to be, right?
Oh, yeah, absolutely. I mean, just people don't have the 20% down
Right.
anymore. Absolutely. But that doesn't mean that there's not a lot of good qualified people who don't have the 20% down. And that's kind of where the LPMI comes in.
Well, it's important to get into home ownership so you can be in a situation to stop throwing money down the rental hole. Why send your landlord to Hawaii on vacation with your money when you could be building equity and a foothold to a future financial freedom for yourself? So even if you have to do something with mortgage insurance, it's probably a great idea to get yourself, if you're in a position, into home ownership. But talk to me about lender-paid mortgage insurance because this could save some people some money.
Absolutely. Lender-paid mortgage insurance is simply it's mortgage insurance. Let's not kid ourselves. It's still less than 20% down, but there's no monthly payment. So what lenders do is lenders make a premium on these loans. So what a lender will do is they'll raise your rate. So in the perfect idea, let's say you got a $100,000 loan and you put 5% down. Your mortgage insurance on that payment is going to be about $85.
Okay.
Okay.
All right.
A lender would say, hey, you know what? At 4 1/4, your mortgage insurance is $85. I could raise you to 4 1/2, 4 5/8, 1/4 to 3/8, and I can eliminate that mortgage payment. Now, the first thing you say is, well, why would I do that? Why would I get a higher interest rate? Well, the higher interest rate might change your payment $25, $30, but you're eliminating that $85 payment.
So you could be ending up saving $50, $60 a month on your monthly payment by taking advantage of this opportunity. And how that works is because the lender is going to make money in the long run off the higher interest rate, so they're able to pay that mortgage insurance up front.
They pay it up front at closing. So at closing on your good faith estimate, you'll see a fee. You just it won't be charged to you. It'll be paid outside. The lender is essentially taking the premium he made from that higher rate and paying that one-time fee so that you can essentially put less than 20% down and not have mortgage insurance. Now, the beautiful thing for the lender is he's still covered.
Yeah.
Because he bought the policy.
Yeah.
Right.
So he's still covered in the long run. And it's pros and cons.
Right. So the pros, let's talk about the pros first.
The pros are simply put, your payment's less. And I mean, I'm talking about 100,000. When you get up to 200, 300, 400,000, you're talking about a dramatic
hundreds of dollars a month.
A couple $100 in savings a month.
Yeah.
So I think for every individual, it's different. You just need to ask yourself, what you're doing and what your long-term goals are.
Well, let's talk about the con, because there could be a situation where it's not a good idea for the American dreamer to do that. Why would they not want to do it?
Well, the breaks are based on credit. Okay. So sometimes the rate might go up as high as 3/4. Now, if the rate's going to go up as high as 3/4, I don't care how much you're saving, it's not worth it because in the long run, you're paying a lot more.
Yeah.
Another con would be I plan on staying in the house for the next 30 years.
Right.
Well, if you're planning on staying in the house for the next 30 years and only the first 5 or 6 years is going to have mortgage insurance, you might want to try to get your rate as low as possible.
Because, if you're going to be there for a long, long time, like 20, 30 years, that mortgage insurance was going to go away after 5, 6 years of payments.
Absolutely.
And if you're locked into this higher premium, this higher rate,
It's
then
there.
It's there to
Right.
the length of that loan.
Another really good pro, though, is so obviously you need to ask yourself what your plans are, what's your long-term plans. But then a pro here is, remember, for a lot of people, not everyone, but for a lot of people, mortgage insurance isn't tax deductible.
Yeah, right.
So if you are planning on staying in the house for 5 to 10 years, well, for the first 5 years you're dropping your payment a considerable amount, and your entire payment is tax deductible.
Yeah, that's right. That's right. That's a good point. That little higher bump in interest is a little bit higher bump in tax deduction as well.
Right.
Exactly.
Well, that's great. I appreciate you. Tim Pascarella of Team Pascarella, powered by Ross Mortgage, the kind of professional who knows the ins and outs, who knows what questions you should be asking. Give us a call off air anytime, 248-545-4700. That's 248-545-4700. And you can get in touch with Tim and help you with your questions. Tim helped us with our mortgage.
Yep.
And we really appreciate all the help you've been to so many clients over the years.
Or
Thank you.
Or you can certainly go online to MichiganRealTalk.com, MI Real Talk, or like the Michigan Real Talk Facebook page. And you've got a constant stream of great information coming at you from some of Michigan's finest professionals. Speaking of which, another fine professional in studio with